Welcome to lecture 25 of financial management. We are continuing our discussion on the cost of capital. Previously, we discussed what cost of capital is, and then our second lecture was on cost of equity, where we saw that there are two different models that can be used to estimate cost of equity. First one is the dividend discount model, which we have borrowed from stock valuation, and the second one is the CAPM model. So in previous lecture we discussed CAPM model, but in this we are going to solve certain examples of CAPM model. Then we are going to explore how do we find the cost or estimate the cost of debt and the cost of preferred stock. Once we are done with the three components, the cost of equity, the cost of debt, and the cost of preferred stock, then we are going to input these costs in the WACC formula. Okay, so we saw what CAPM is, the required rate of return or cost of equity is equal to risk-free rate plus the beta into RM minus RF, return on market minus return on the risk-free asset. So suppose the risk-free asset is 8%, this would be our RF. The market return is 14%, this would be our RM. And the sensitivity of the stock is 1.2, this would be our beta. So we need to find the cost of equity, which would be, the formula is RF plus beta into RM minus RF. So if we input the values, RF is 0.08 plus the beta is 1.2 into RM is 14%. Minus again the RF is 0.08, and this would give us the value of 0.15 or 15%. So according to CAPM, our cost of equity, cost of getting finances from common shares by issuing common shares is 15%. Okay, so what are the advantages and disadvantages of this CAPM model? First, the advantages are the disadvantages of the dividend discount model. So the disadvantages of dividend discount model become the advantages of the CAPM model. And one of the disadvantages of dividend discount model was that it did not take into account the risk factor. So now the CAPM takes into account the risk factor. And how is that so? It takes into account the systematic risk, and remember we show that beta is used to measure systematic risk. For now we are just going to understand some aspect of this, and later subjects, say for example corporate finance or investment, we would further explore this concept. With non-constant dividend can also use the CAPM model. So for example, in previous model, dividend discount model, which we saw that there must be some dividend first, and secondly the dividend should have a constant growth, right? So for those firms that do not pay dividend and they do not have a constant growth in their dividend, can also use this specific CAPM model. Right? These are the advantages of CAPM model. The disadvantages are that the estimates of beta and market risk premium may be poor. So remember the beta value, although in this equation or in this example it was already given, right? But later on when you progress, you would understand that we need to estimate the value of beta ourselves, and we need to estimate the risk premium. So our estimates of the market risk premium or the beta might be poor. It is not necessary, but if our estimates are not good, then this model will not give us a better results. So as with the dividend discount model, where we estimated growth rate, we estimated it based on the historical data or the analyst forecast. If our estimate of the growth rate was not good, then our dividend discount model won't give us an accurate picture. So similar is the case with CAPM. In CAPM, we estimate the beta value, and if beta value is not accurately estimated, then the estimate of the CAPM model, the cost of equity estimated by the CAPM model, would not be a good estimate. So the past may not always be a good guide for the future. So we estimate the beta based on the past historical data, and normally, although there is some kind of a pattern that is there, but sometimes the past data may not exactly predict the future data. So this is one of the disadvantages of the CAPM model. There is one more way, which is called bond yield premium, which can be used to estimate the cost of equity, but it is not a model per se. It is okay. So what? Let me give you an idea. Remember, we have bonds and then we have stocks. Which one is more risky? Obviously this one. Stock is more risky, bond is less risky. Bond have a specific pre-decided interest rate that is paid irrespective of the profit or loss. Stocks do not have a pre-decided dividend. They suffer from profit and loss, and if the profit is lower or the loss, the company occurs a loss, then there might not be a good return from the stock. So that means that stock are riskier as compared to bond. So stock must earn some extra return as compared to bond. So if bond is paying 5%, then stock must pay, say for example, 2% additional premium for the risk. So that means that a stock must pay 7%. If there is another stock which is more risky compared to general stocks, say for example, there is the stock of oil sector. Oil sector is generally considered a risky stocks. So they must pay, for example, 4% premium, 4% higher return as compared to bond. I mean, no one would buy this riskier stock if they were to pay a total return of 4%, right? Why is that so? Because if bond is paying 5% and stock is paying 4%, stock is riskier and it is paying 4%, bond is not riskier, it is paying 5%. Why would you invest in riskier stock when you can earn a higher return from a less risky security? So obviously a riskier asset would need to pay a higher return. So assume this is the extra premium, this $2 is the extra premium over and above this $5. So if this stock pays 7% return, then people would buy this stock. So this same idea is used in this bond yield premium. So some analysts add the risk premium of 3 to 5% on interest rate to calculate the cost of common equity. So this is the easiest way, but it is not a model, it is not an accurate way, it is just a guesswork. So what we can do is we can find the cost of equity by adding the risk premium to the bond yield, right? So BY stands for bond yield. Bond yield is 5% in this example, for example, and bond risk premium, additional risk premium that we are going to occur. So for example, if there is a question that says that the bond yield is 5% and the investor expects 2% additional return on the risk by investing in the stock, common stock, then the cost of equity would be 7%, right? So this is just an idea, but mainly we use the dividend discount model and the CAPM model. There are some advanced models, for example, FF model, but for now we are going to stick to these two models. Okay, so next component, the first component was cost of equity. The second component is cost of debt. So it is the return that is required by the lender. So let's say you lend 1 lakh rupees to a firm. Obviously, you would require some return, right? So this return becomes the cost for the company. So it is a return on your investment for the investor, for the lender, but for borrower it is cost of debt. So cost of debt is equal to the nominal cost, the nominal interest rate. This RI stands for nominal interest rate, into 1 minus the tax rate, right? Okay, where RD stands for cost of debt, RI stands for nominal interest and on the rate of debts, and T stands for tax rate. Now, why do we need, let's say someone borrows 1 lakh rupees from a bank and there is a 7% interest on that borrowed amount. Why shouldn't we consider just this 7% as a whole as our cost of debt? Why do we need to deduct the 1 minus tax rate? Why do we need to perform this equation? The reason is that if you look at your income statement, you would see that we have gross profit. We have sales minus cost of goods sold. We get gross profit. We deduct the selling and administrative expenses, right? Then we get EBIT, earning before interest and taxes. What do we do next? We pay interests, right? After that, we get EBT, earning before taxes. Now what do we do? Then we pay taxes. So that means the higher the tax amount you pay, the higher the interest amount you pay, the lesser the tax amount you would have to pay. Why? Because first the interest would be deducted from EBIT and then you would have to pay on the remaining, the tax on the remaining amount. So if interest is higher, the interest amount is higher, the EBT would be lower and the tax calculated on this EBT would be lower. As compared to this one, let's say your company do not take any loan, then what would happen? A gross profit minus expenses, you would get EBIT. There would be zero interest because you haven't taken, you haven't borrowed any money. Your EBT would be higher as compared to this firm, and your tax rate would be higher. So what this portion of this equation is, it is called tax shield. This interest saves us from paying taxes, paying higher amount of taxes. So as compared to, for example, if a firm needed 1 million rupees to start a factory, and if they generated this whole 1 million amount from by issuing shares, common shares, then they would not pay any taxes, any interest, sorry. So the whole amount that they earn, they would have to pay taxes on this EBIT rather than on the lesser amount of EBT after deducting interest, because EBT would be equal to EBIT. So their taxes would be higher. Now, as compared to this firm, let's say there is another firm, firm B, which borrowed this 1 million from a bank. So they have to pay the interest. When they pay the interest, their EBT would be lower. They would have to pay lower taxes. So this interest is essentially saving us from taxes. So what we need to do is we need to deduct that taxes part, that saving part from the nominal interest. So if we are paying 7%, but we are saving, say for example 1% from taxes, then our actual cost is not 7%. Rather it is 7% minus 1%, which is 6%. So I hope you get the idea. Let me revisit this idea. if a firm need to borrow 1 million and it goes to a bank and the bank asks the firm that it need to pay 7% interest, then a layman would consider that this 7% is our cost of debt. But by paying this interest, what we are doing is we are saving our tax. So we need to deduct that saving from this cost. Let's say that saving of tax is 1%. So actually we are paying 6% of cost of debt on our borrowing. The efficient rate, the effective rate is 6%. Okay, let's have an example. The interest rate on 30 years bond is 12%. Remember, bond is also a loan, is a liability. If government has imposed a tax rate of 30%, then we need to calculate cost of debt, and the cost of debt would be RD. RD denotes cost of debt is equal to 12% is the nominal interest rate into 1 minus 30% is the tax rate, and this would give 0.084 or 8.4%. So our effective cost of debt is 8.4%. Although we are paying 12% as an interest, but we are saving some tax amount. So if we deduct that saving of tax amount from this interest, we are actually, the cost of this bond, issuing this bond is actually 8.4%. Okay. The last component is the preferred stock. Remember, preferred stock or common stocks, they are perpetuity. And this preferred stock is a perpetuity because we get a fixed amount, and because the company is considered a going concern, so we expect that it would operate for an infinite time period. So if you remember from the time value of money chapter, how do we calculate the present value of a perpetuity? It was C by the future value, the R, the interest rate, right? The cost of capital, and that would give us the present value. And if you remember, we used this idea in case of bonds and stocks. So what we do is, let's say if we are given this value and this value and we need to find this one, then the equation would become R is equal to C divided by P naught. So this is what we have essentially done in this formula. Cost of preferred stock is equal to dividend of preferred stock. In case of time value of money, it was cash flow, and we are just denoting the cash flow by D because it is dividend of preferred stock divided by price of preferred stock. So DPS stands for preferred stock, dividend of preferred stock, market price, not the face value, remember. Let's move towards the example. Suppose a company offer a dividend of 5 rupees per share. The preferred stock cost 50 rupees per share. We need to find the cost of preferred stock. The formula is cost of preferred stock is equal to dividend divided by the price of preferred stock. That would be dividend is 5, price of preferred stock is 50, and that would give us the cost of capital of cost of preferred stock of 0.1 or 10%. So if a company issue this preferred stock, then their cost of this issuing a preferred stock would be 10%. Now once what we did is, let me summarize this whole idea. What we did is we understood different methods of finding the cost of equity, then cost of debt, and then cost of preferred stock. Because remember, in the case of WACC, we have different sources of financing, and we need to have their costs. We need to find their costs. So once we find their cost, we would plug these costs into the WACC formula, and it would give us the weighted average cost of capital of that firm.